That's right, Ethan, and welcome to the Daily Hunt for Multi-Baggers. It's Saturday, November 1st, 2025, and we're diving deep into the data collected yesterday, Friday, October 31st.
That's right, Ethan. Our AI has been sifting through a pretty active market. We saw a significant number of posts flagging a wide range of different stocks this time.
Absolutely. There's a real buzz out there. While some companies are showing incredible growth potential, the sentiment is quite mixed.
And I'd say for a lot of these, the underlying KPIs are flashing some serious risk signals, even where the community sentiment is high. So we'll be separating the hype from the reality today.
All right, let's kick things off with Novo Nordisk, symbol NVO. Now, the community sentiment here is pretty bearish, with folks sharing their pain. But looking at the numbers, NVO boasts a fantastic return on equity and net profit margin, showing it's incredibly efficient at generating profits. Plus, that dividend yield could be attractive.
Well, Ethan, while those profitability metrics are indeed strong, we can't ignore the current reality. NVO's price at $49.46 is drastically lower than its 52-week high of $112, practically scraping its 52-week low. And that high debt-to-equity ratio of 59.06 is a red flag for risk. Plus, those ongoing legal disputes with Pfizer add a layer of uncertainty. We previously rated NVO as a stay away multiple times, and unfortunately, the current data just reinforces that.
So the verdict on NVO then?
It has to be stay away. Next up, Tesla, TSLA. There's a lot of chatter about this one, with many users saying it's unshortable and that it defies traditional logic. Even Bank of America recently raised its price target.
And that's the thing, Brooke. People have consistently underestimated Tesla. Its momentum, its vision for sustainable abundance, it just keeps pushing higher, often near its 52-week high. That's the kind of disruptive innovation we look for.
But disruptive doesn't mean invulnerable. That price-to-earnings ratio of over 314 is astronomical, suggesting an extreme overvaluation that's simply not backed by its current net profit margin of 0.05. The market is pricing in decades of perfect growth, which is a massive risk. We've consistently flagged TSLA as a stay away or speculative gamble in the past, and my KPIs haven't changed that view.
So for Tesla, we're saying?
Stay away.
Okay, let's talk about the big one, NVIDIA, NVDA. We've got a lot of conflicting signals here, but I gotta say, the bullish sentiment is strong in many corners. People are excited about its leadership in AI, massive AI spending from Amazon, and those huge Blackwell chip deals. Their revenue growth is an exceptional 55.6%, net profit margin is over 52%, and return on equity is an astonishing 109%. Those are fundamental powerhouse numbers.
I hear you, Ethan. Those growth and profitability numbers are undeniably impressive. However, the market has already baked in a huge amount of future success. The PE ratio is nearly 58, and the price to book is an extremely high 49. The current price is also very close to its 52-week high, and its market capitalization is nearing $5 trillion. While the company is performing, the valuation means there's just less room for significant upside and a lot more room for disappointment if they don't hit every single target perfectly.
Our previous ratings for NVDA have been quite mixed, swinging between buy and stay away and cautious buy. So, weighing that incredible growth against the valuation, where do we land today for NVDA?
Given the strong performance, but also the significant valuation risks, we're classifying NVDA as a cautious buy. Next up, Robinhood, TSLA. We saw a user make a pretty bold bet with 460,000 euros on earnings, which shows conviction, and there was some positive news about a judge's order impacting the stock.
That's right, Brooke. It suggests some positive tailwinds, and Robinhood has shown it can jump on good news. There's always that disruptive potential for fintech.
The challenge is comments quickly turn bearish, with some even questioning if the stock could drop to like $40. Its PE ratio is a whopping 74.51, and the debt-to-equity ratio is an alarming 161.17. That's a huge amount of leverage, Ethan, signaling significant financial risk. Hood has been a stay away for us often in the past, and the current KPIs don't change that.
Another stay away then for Hood?
Yes, stay away.
All right, let's talk about Nebius Group, NBIS. This one has strong bullish sentiment tied to the AI data center explosion, with some users reporting over 50% gains in 3 months and committing half their portfolio. Plus, news of their new AI Cloud 3.0 Aether sounds very promising.
Now that user sentiment is certainly exciting, but we need to look under the hood. While the stock has seen massive price appreciation, its PE ratio is over 161. Even more concerning, its operating margin is negative, and its net profit margin, while positive, is very low at under 1%. Plus, a debt-to-equity ratio of 32.427 indicates significant financial risk. The company is burning cash operationally despite the hype. NBIS has mostly been a stay away or speculative gamble for us, with just one cautious buy recently.
So the excitement of AI, but the caution of the numbers?
Precisely. For NBIS, it's a stay away.
Next up is Opendoor, OPEN. Another one where users are reporting substantial gains, saying it's up over 50% in 3 months. That kind of momentum, it's hard to ignore. And we saw news directly stating it's trading up today.
And that's fantastic for those who've ridden that wave, Ethan. But for new investors, the underlying financials are a serious concern. Opendoor has negative net profit margin and negative earnings per share, meaning it's simply not profitable. And an incredibly high debt-to-equity ratio of 346.17 is frankly terrifying. We've rated Open as a stay away consistently, and these KPIs confirm it once again.
So for Open, the verdict is clear?
Yes, stay away.
Let's talk about IREN Limited, symbol IREN. This company is riding the AI power pivot wave, with massive reported gains for users, and analysts are even re-rating it. It sounds like a fantastic growth story.
It certainly has a compelling narrative, Ethan. However, that PE ratio is an astronomical 114.7, indicating extreme overvaluation. And more importantly, H.C. Weinstein recently downgraded IREN to a sell, setting a price target significantly below its current price. Plus, its beta is over 4, which means it's incredibly volatile and high risk. We've seen a mix of ratings, but mostly stay away or speculative gamble for IREN.
That downgrade is tough to ignore. So for IREN,
it's a stay away.
Finally, SOFI Technologies, SOFI. We're seeing strong revenue growth and a healthy net profit margin, and UBS even raised their price target. That sounds like a company with solid potential in the fintech space. While the growth and net profit margin are positive, Ethan, SoFi still carries an extremely high debt-to-equity ratio of nearly 32. Its PE is 53, indicating high expectations, and its return on assets is quite low. This suggests they aren't efficiently turning their assets into profits, and that high debt could become a significant burden if market conditions shift. We recently had one buy rating for SoFi, but before that it was mostly stay away. With these high-risk KPIs, I have to downgrade it back.
Back to stay away?
Yes, stay away. All right, let's wrap up our hunt for today. Here's our compiled list of candidates for deeper analysis. Investigate as buy, none. Investigate as cautious buy, NVIDIA Corporation, NVDA. Investigate as speculative gamble, Nebius Group NV, NBIS.
And that brings us to the end of today's episode.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thank you for joining us on the Daily Hunt for Multibaggers.
We'll catch you next time.